Why is my borrowing capacity so low? If you've ever asked yourself this, there's probably a tangible reason, not just bad luck. And I'll explain what affects your borrowing capacity and how you can change it. Oftentimes I hear clients say, I make $500 a week from my property and the interest is only $1,200 a month. It basically covers itself. Have you worked it out correctly? Are your calculations correct? Well, I want to answer that question for you by explaining the 5 most important aspects when it comes to knowing how much you can borrow. If you can work on enhancing each aspect individually and even collectively, you'll be on your way to achieving what you want. Hi, I'm Nathaniel, a mortgage broker with Loan Lounge. We help first home buyers and business owners secure finance. The main 5 aspects to determining whether your loan will be approved is your character, your collateral, your capacity, your capital, and conditions. Let's start with character. Have you ever lent money to someone? Did they pay you back? Let's say there were 3 scenarios. Person 1 paid you back as agreed and on time. Person 2 paid you back but in their own time. That is, whenever they wanted and not part of the agreement, and they made late payments as well. And then person 3 didn't pay you back at all. So tell me, would you lend to these people again? And depending on your answer, ask yourself why. That basically sums up character. Does the person you are lending to have a willingness to pay? Because there are some people that don't want to repay, and just like you won't lend your own money, the lender or banks won't lend theirs. Simple, isn't it? If you owe people money, my tip is pay it back. Number 2 is capacity. Capacity refers to your capacity to repay the loan. In other words, can you repay the loan with the income that you receive? Just imagine you were a lender and your friend or family member asked to borrow some money. Who would you lend to? Someone that you were close to but didn't have a job and just bummed around all day, compared to someone that worked hard, has been in the job for a long time. Tell me, who would you lend to? The easiest way to think through this is with income and expenses. Basically, what comes in and what goes out and what is left over. Do you have enough left over to pay the loan? Some people may say, yes, that's easy. However, banks do take into account the following. The first one is net income received. Second, they can look at your living expenses. Third is limits of any credit cards you have access to versus how much you actually owe. Banks also add a buffer on top of the actual interest rate that you're being paid. So they add about 3%. Then there is this multiplier called debt to income ratio, which caps how much you can actually borrow. So if your income was $100,000, 6 times that is $600,000. The maximum you could actually borrow is $600,000. So as a professional, we take into account all these variables and see how they interact to find out the best home loan solution for you. Next up is capital. I like to refer to capital as hurt money. It's the money that you've saved up for many years and now you are putting it towards a home or an investment property. It's that money you let go, and you know what? It hurts. The bigger the pain, the more the lenders like it, to be honest. Everyone knows that paying your credit card is less painful than paying by cash. It's also been proven that you spend more when using debt. Look at the property prices. These crazy prices are sustained by low interest rates. Eventually, they will have to go up. In terms of purchasing your own property, capital can be accessed in 2 main ways. It's either cash or savings, or using the equity available in a current property asset that you own. In a nutshell, equity is the value of your assets in dollars. The bank generally allows you to use a large portion of your available equity to an amount of 80%. So if you own a property worth $1 million, 80% of that is $800,000, and if you owe $500,000, taking away that existing debt leaves you access to $300,000 of capital, which you can use for your next purchase. We'll talk more about this in another C, which is collateral. 2 extra ways that you can access capital for first home buyers are accessing equity through a guarantor loan or using your parents' property to access the capital as well. Government grants, like the First Home Buyers Grant, transfer duty exemptions, and the First Home Loan Deposit Scheme. There are some tricks of the trade where you can actually put no money down to purchase your home, provided you have all the ducks lined up. In conclusion, there are different options that can help you towards your capital. But just know that generally, it's a good habit to spend less than you earn and show a savings record over time if it's your first home. This is true whether you are borrowing or not, and forms the basics of good investing. Next up, collateral. Collateral is another word for security. When a lender is looking at your security, they are thinking if you did not repay the loan, which is a capacity question, then what can I fall back on, or how can I get my money back? They do this by holding your property as security or collateral. Generally, they have a mortgage over your home, so technically you may have bought the home and your name is on the title, but you can't do whatever you want with the property because there is a mortgage on it. The word mortgage is broken up to mort and gage. Is an old French term meaning mort, dead. Gage is pledge, or known as a death pledge. Why the hell would you want to go into a death pledge? It's called this because the deal or pledge is dead when the debt is paid or the payment fails. So how do you get out of a loan? Easy, you pay back the loan. Either you pay back what you owe with your income or the sale of the asset. Usually when you borrow, the type of asset that is taken as collateral will determine your interest rate and loan term. This is because some assets are deemed riskier than others. Typical assets we use are houses, units, apartments, retail shops, warehouses and land. But there are other assets like cars, businesses and equipment as well. The main thing is collateral provides the lender with security. They feel secure about lending you their money, which you are repaying back with interest. So the higher the interest, the higher the risk for the lender, and vice versa. I hope that explains the C of collateral to you. Finally, conditions. Conditions can be a very wide topic. However, I believe if you can get the first 4 C's right, you are 80% of the way there. There might be a few things that can trip you up, depending on what the conditions are on the loan. The conditions can be the lending market and what is external to the lending market. A key consideration for conditions is the specific purpose of your loan. Purpose determines the factors that will go into considering the term, the interest rate, and conditions surrounding the loan. Other key conditions to be aware of are regulatory changes, which may intervene to slow down lending or cap the amount that borrowers can actually borrow. Finally, there's economic change as well. The rapid increases or even slumps in the market can really change the lender's appetite. So these are the 5 C's of credit. And by understanding these 5 C's, it will help you move closer to getting that approval. At Loan Lounge, we are expert mortgage brokers who help you make sound financial decisions. If you have any questions, please leave them in the comments below. Otherwise, give this video a like if you found it useful. I'm Nathaniel from Loan Lounge. See you next time.